FedEx stock is up 70% in recent months, and the name may continue delivering positive returns in the near term. FedEx, the company that moves goods through a vast network of facilities, vehicles, and infrastructure across the United States and beyond, is preparing to separate its most profitable segment into a new publicly traded company. This process is called a spin-off. This new company, FedEx Freight, will focus on industrial freight transportation. With stronger financial performance than the current parent business, FedEx Freight is expected to perform well in the early period after it begins trading. The transportation and logistics sector has gone through a difficult period. However, shares of FedEx have surged in recent months, reaching around $380, a gain of about 70% in just 5 months. This rise comes from two main factors. First, transportation and logistics is a cyclical sector. Earnings typically decline for a period due to macroeconomic conditions, then recover as demand strengthens. Historically, FedEx stock has moved through bearish and bullish cycles, but the current upswing has been unusually steep and appears to be just beginning. The second factor is the announced spin-off of one of its most profitable divisions, FedEx Freight. This new company is expected to begin trading on June 1st, and FedEx shareholders will be entitled to receive its shares. The spin-off process historically has generated strong returns for investors who focus on these situations. As Joel Greenblatt said, corporate spin-offs can be a very fair ground for finding hidden value. On this channel, we evaluate upcoming and recently listed spin-off companies. If you're interested in these opportunities, please like and subscribe. FedEx is separating its freight division because transporting large industrial shipments through terminal networks is fundamentally different from its core business of delivering small packages. After the separation, FedEx Freight will operate as an independent company, with greater flexibility in partnerships, pricing strategy, operational structure, and long-term planning. However, the key point is valuation. As I've mentioned in previous videos, when a spin-off begins trading independently, its share price often declines temporarily. That can create an opportunity to buy solid business at an undervalued price. This temporary weakness is known as the spin-off sell-off. When a new company is separated, shareholders of the parent automatically receive shares of the spin-off, even if they didn't want them. Many investors, especially large funds, sell those shares, creating short-term selling pressure and a lower starting price. Over time, as the market reassesses the business on its own, returns can improve significantly. We are seeing this pattern with Solstice and Quinity. Both were spun off in October 2025. After about 2 difficult months, their shares rose roughly 80% and 50% over the next 2 months. If you'd like more information about these companies, watch this video. Let's continue. There is also a valuation gap to consider. Spin-off companies often trade at a higher sector price-to-earnings multiples than their parent companies. FedEx Freight will operate in a segment with an average PE ratio around 30 times, while FedEx trades closer to just 20 times, a gap that could support a higher valuation once the new company, FedEx Freight, begins trading independently. Now let's look at FedEx Freight's financials. The company has $6.2 billion in assets and $2.6 billion in liabilities. It generates about $8.8 billion in revenue and $1 billion in net income, which implies a net income margin of roughly 12% and a return on assets of about 70%. For comparison, XPO, a similar-sized company in the same sector, has an assets to liabilities ratio of about 1.2. Its net income margin is around 4% and its return on assets is about 8%. Despite these lower profitability metrics, XPO trades at a price-to-earnings ratio near 80 times, reflecting strong growth expectations for the transportation and logistics sector. If FedEx Freight maintains its current performance after a spin-off, these fundamentals could support strong returns in the early period of independent trading. However, there are risks that could affect the price of FedEx Freight shares. If the freight cycle is weaker than expected, those high price-to-earnings multiples could compress. In an environment of political uncertainty and volatile fuel costs, expectations for a strong sector upswing may not materialize. The transition to a standalone company also introduces execution risk. Operating independently may lead to a higher cost structure and the loss of parent company synergies. As a pure freight business, the company will also be more exposed to supply chain disruptions. As for my approach, I have already invested in FedEx to receive shares of the spin-off on the distribution date. Now I'm waiting to observe how FedEx Freight trades once it begins trading independently. FedEx shares have already risen about 70% over the past 6 months, so near-term upside may be more limited. If the typical post-spin-off sell-off occurs and the new shares decline in the first months, that could create a more attractive entry point. In conclusion, after the spin-off, we are no longer looking at one logistics company, but 2 distinct businesses. FedEx becomes a parcel delivery and e-commerce logistics company, while FedEx Freight becomes a pure industrial freight transportation business, focused on large shipments between companies. This new company could present an attractive opportunity once it begins trading independently. If you found this analysis useful, please like and subscribe. See you in the next video.